The S&P and the Dow both nearing their all-time closing high from October of 2007. But something funny happened on the way to the rally. The S&P 500 is far away, actually, from its all-time high back in 07, whereas the Dow is within striking distance. So it's time to take a look at the technicals here. Mark Newton is a chief market technician for Gray Wolf Execution Partners. And Mark, we were just discussing this note that I came across this morning, put out by Bespoke, signaling the fact that over the past 15 trading sessions, the Dow has made higher highs. So it's made the steady march higher toward its record high of, from October 9th, 2007. Yep. But the S&P 500, the NASDAQ, and the Russell have made lower highs, which technically speaking, I would imagine is not a good sign.
That's still a little bit of a concern. I mean, you look, the Dow even yesterday made new highs, but yet the NASDAQ and the S&P did not. And a lot of people are talking about Dow 14,000. The Dow is still under its 2007 highs of 14,200, and also the Russell 1,000 and the 3,000 have not really participated as well. So they're all up against levels of highs, whereas some of these indices have broken out. And so, that's going to continue to be a concern, at least with regards to what we call intermarket divergence.
Right.
Where not all the indices are hitting new highs at the same time.
And, of course, a lot of people will poke at the Dow and say, you're counting down to this record on the Dow, but it's a snapshot of 30 companies. It's not representative of the broader markets. In terms of the S&P 500, what are the levels that you are watching?
Well, over the last couple of days, and the S&P has shown signs of peaking out, and we have a short-term basis where the S&P got to near 1525 to 1530 and pull back. My thinking is the short-term is still a big, issue, that we could actually pull back to levels right down near 1475 with regards to S&P cash and 1450 with regards to the future. So those are the levels on the downside, and those would still be within this broader uptrend since November. So that would actually, a sell-off would provide a better buying opportunity in the short run. So that's on the downside. On the upside, 1525 to 30 is very important. If the S&P gets above 1530, it's likely to challenge its own 2007 highs, which is near 1576.
Right, but let's be clear here. Short term, you may be a little bit concerned about the S&P 500, but longer term, you do like this price action.
That's correct. It's mostly just short-term concerns only. A lot of it's regards to momentum deterioration. Last week, we broke down on fairly serious volume and breadth, which was much more negative. Regardless of this new don't fight the Fed mentality, the rally yesterday did not help us to get back a lot of what's been done. So you see this trend line really over the last month. It really was broken last week. We've had a series of lower highs. Now we're up near 1520. So with regards to S&P futures, that's going to be a key level, at least in the short term. But momentum right now is still negative on a short-term basis. And you have the intermarket divergence. You have a huge run-up in sentiment just over the last couple months, which would be expected.
As measured by what?
Well, investors' intelligence, AAII, consensus, market vein, the combination of those shows sentiment. They're all contrary.
The more bullish, the more likely you see markets pull back.
That's correct, and they all follow price action. So the S&P is up 12% since last November's lows. As it would be expected, sentiment has gradually followed this move up to new high territory. But now we have a number of different indices that are all near former highs. The U.S. is starting to play catch-up with what's happened in Europe. Europe peaked actually in late January. We saw China with one of the biggest declines also in the last few weeks. So the S&P is finally starting to show a few signs of deterioration. I have concerns because not all the stocks are following this market's move to new highs. Right. We've seen deterioration in technology and materials over the last 6 months. Those have been under constant pressure. So we need to see
transports, healthcare, staples hitting new highs.
Well, that's a good point, Melissa. I mean, the market's up 7% this year, but yet it's been largely defensively led. So consumer staples, healthcare, you've seen a big move in utilities over the last week. But by and large, a lot of these sectors have already made their moves, like financials, which are up at record highs. So it's important to be selective at this stage.
Mark, thanks for coming by Post 9.
Thank you.
Mark Newton of Gray Wolf.